Good morning, everybody. Welcome. So glad you took some time out of your busy day to join us this morning. My name is Dave Redebaugh. I'm the Internet Marketing Coach with Cindy Bishop Worldwide. And basically, we're just real excited to have you guys join us today for this very important training on manufactured housing. So, and I'm happy to be able to have Tracey Legare with us today to share this information with you guys. I'm going to give her the opportunity to go ahead and introduce herself, talk about who she is, where her background is, so you understand the expertise that she has with this particular topic. So she'll be able to tell you more about herself and her background. Just a couple things that I wanted to note real quickly that most of you, I think, have already seen that we have the chat box. And I want you to be able to take advantage of that. That really is the way, because all of you are muted right now, or we would have a tremendous amount of background noise. So basically what we want to be able to utilize is this chat box for a way for you to be able to share your thoughts, your comments, your questions. Please make sure that you put those in the chat box, and we will be able to address them as we go. So, so that's the first thing. We love questions. We love your comments. So please be active on this thing as much as you can with the chat box. Second thing is, geniuses take notes. You definitely want to make sure that you have an opportunity to take down the notes, the things that Tracey shares today that are going to be meaningful to you and your business. So make sure you take advantage of doing that. And lastly, friends share stuff. What's going to happen with this? This is actually being recorded. When we're done with the recording, we'll be able to have it uploaded onto the Cindy Bishop Worldwide YouTube channel, okay? And what we'll do is I'm going to send the link for this YouTube video of this presentation to Tracey. So that way she can follow up with you for any questions you may have, but it also gives you an opportunity to share this with friends that you know that may benefit from this same information. So with that, you guys didn't jump on this morning to hear from me. You jumped on, I'm sure, to hear from Tracey. So Tracey, if you could, go ahead. The floor is yours.
Thanks, Dave. My name is Tracey Legare, as Dave said, and I've been in the industry for about 27 years, doing specifically mortgages. I've been doing manufactured homes since day one, so I have a lot of experience with this type of housing. And currently I'm with Fairway Independent Mortgage. I've been with them for 2 years. And looking forward to doing my first webinar today. So we'll just go ahead and get started. And the first slide, basically what is a manufactured home. This is Freddie Mac's definition, which basically it's a home built on a permanent frame that meets the National Construction and Safety Standard Act as set forth by HUD and is affixed to a permanent foundation. So that's the basic definition of what a manufactured home is. A little bit of the history of mobile versus manufactured home is really confusing to me when I first got in the industry, because most of the seasoned agents were calling all these homes mobile homes. Some of the newer agents were using the term manufactured, so it was a little confusing. Originally, the focus of this form of housing was its ability to relocate easily. Units were initially marketed primarily for individuals whose lifestyle required mobility. And it was especially popular among the military. In 1974, Congress passed the National Mobile Home Construction and Safety Standards Act, which created the HUD code regulations. The regulations went into effect in 1976, and the Housing Act of 1980 mandated that the term manufactured be used in place of mobile in all federal laws and literature that referenced homes built after 1976. So basically, if it was built prior to 76, it's technically a mobile home. After 76, it's a manufactured home. The intent of the code was to improve the durability and the quality of the manufactured homes. The act set forth standards for the design and the construction, body and frame requirements, thermal protection, plumbing and electrical. One of the things that they did was they eliminated the aluminum wiring, which was in the original mobile homes built prior to 76. Just with that alone, since 1980, home fires have decreased by 2/3 in this type of housing. Also, fire safety and energy efficiency were part of the act. Just a little tidbit, it's the only federally regulated national building code. If you think about it, with stick-built homes, if you're building, say, in the Outer Banks and, on the beach versus in the mountains on, in dirt or more rock, your codes are going to be completely different from state to state or county to county. So this is regulated on the federal level. And a lot of it, what's regulated is the materials that are used in the homes. And like I said, the safety and the energy efficiency requirements. Some of the pros and cons of manufactured homes. The pros, they're more affordable. Affordable housing stock right now is scarce. So we're seeing an increase in prefabricated homes right now. Flexibility, you can move them instead of selling the home. And there's easy customization. A lot of these, when you go in to purchase the homes, it's all computerized. You can literally design your floor plan. The materials are pretty much the same as stick-built homes as far as carpeting, cabinetry, even the outside of the home is vinyl, wood siding. You have a lot of options now. The cons, they can be a little bit structurally weaker, although not nearly as much as they were prior to '76. They tend to depreciate instead of appreciate. However, we're seeing right now where the homes are actually selling fairly quickly. I recently had a couple that came to me that live in a manufactured home that's in a trailer park, and they were able to sell the home fairly quickly in less than a month. And I remember years ago, it was a lot more difficult to sell the homes. They actually made over $100,000 between the two of them, and we were able to qualify them for, I think it was around a $250,000 home without selling the current home. They still qualified with their current payment and also with the lot rent. So just something to think about. If they did write the contract with a contingency because she didn't want to get in a situation where if they couldn't sell it, but we were actually able to approve the loan with no contingencies just in case. But just something to think about, if you have anyone that currently lives in a manufactured home and they want to move into a stick-built home, or if they want to move into a manufactured home on property. There also may be some hidden cost. This has to do more with, you may have more repairs, there may be more warranties needed or reinforcement on this type of housing. Purchasing a manufactured home, it can be installed on your own land. We're getting a lot of phone calls for individuals that are actually wanting to purchase manufactured homes and put them on land. So if you are listing land, you might want to check the covenants and see if manufactured housing is allowed and market it that way, because it may help you actually sell the lot. They can be placed in a rental community. Something that, we talked about in one of the CE classes on this was farming actual rental communities. There's one here in Winchester that's actually a fairly nice community that's manufactured housing. Of course, they pay lot rent. And a lot of times those individuals are ready to move, maybe into another manufactured home on land or into a stick-built home. So it might be something to think about. Targeting those type of communities for buyers right now, because like I said, they are selling a little bit quicker than what they did years ago because they are affordable. They can also be placed in a planned subdivision. We don't see a lot of planned subdivisions in this area with manufactured homes, but across the United States, there's about 200 resident-owned communities, which represents around 12,150 homes. With these communities, a builder or developer, and I'm actually working with an agent right now that they're actually looking into doing this in West Virginia. It's, I think it's over in the Paw Paw area. But the borrower, the builder or developer would actually have the customer go to somebody like a Clayton Homes. They do a lot of manufactured homes. They're a dealership, and they also manufacture them. But they could actually go pick out, what they want, The builder would actually pay for the home, put the foundation in, put it on the property, do all the utility hookups. And it's kind of no different than a tract builder, except it's a manufactured home. And then the buyer, of course, would just purchase it as if it's an existing home. That would be what we would call a planned community. Purchasing, hold on a minute. Some of the features of the home, they have now custom cabinets, walk-in closets, bathrooms with recessed tubs, wood-burning stoves. You can have the variations in the floor plans, the decor, and everything is computer-assisted designs. I was in one recently. I've got a friend that owns land that we used to go to when we were kids, pulled up, and I thought it was a modular home. It was actually a manufactured home. It was 2,500 square feet, and it had a wood-burning stove in it. But it's interesting just the size of some of the homes now. I think 2,500 square feet is actually the largest that you're going to find with a manufactured home. But it literally, from the outside, it looked like either a stick-built home or a modular. You really couldn't tell the difference. It was vinyl siding, landscaped really nicely, and you really just couldn't tell the difference. And here again, a lot of the materials are the same as stick-built homes. Additions and alterations to the home. HUD does not include provisions for additions or alterations. Any modifications may jeopardize your home warranty, may create malfunctions or an unsafe home. So approved additions should be freestanding structures that meet building codes and may need a permit. You can contact the manufacturer, state agency that oversees manufactured housing in your state, and HUD or local building officials for more information. So if somebody's going to put a deck or an addition or a porch on the home, it does have to be freestanding. They can't actually add on to the home like you could on a stick-built home. And the one thing that I'll talk about later, when we get one of the requirements on these for financing is a foundation report. And if there are additions on the home or decks, those also have to be inspected. So you want to make sure that whoever you send out is certified to do both. It sounds crazy, but we've actually had situations where the seller has had an inspector go out to do the foundation report and they're not licensed to inspect the decking or the additions, and then we've had to find someone else to go out to inspect those. So you want to make sure if there are additions on the home that you get an inspector that can do both, because it's, the inspections are not cheap. So just something to keep in mind. The next couple slides, we're going to talk about financing a manufactured home, the different types of financing, borrower's eligibility, some of the property specifications, some of the requirements on the appraisal, talk a little more about the foundation requirements, inspections like well, septic, and termite, and then we'll finish it up with the title requirements. Types of financing, conventional, FHA, VA, and USDA are going to be your most common. On conventional, you can do the 3% down program. We also have an MI company right now, and this is whether it's manufactured or not, that if you have two first-time home buyers that are purchasing a home, and let's say they're a little bit worried about both incomes qualifying and they just want to qualify on one income, but you really can't get them into the house that they need without both incomes. We have an MI company that will actually, if one of them loses their job, the insurance will actually kick in and pay 6 months of their mortgage payments up to $1,500 a month. So it might be something, if you have buyers in that situation, where that might ease their concern a little bit, knowing that if something did happen, they would have 6 months for the other individual to purchase or to find a job, and they wouldn't have to worry about making the mortgage payment. FHA is probably the most popular program. I would say 80% of the loans that I've done over the years have probably been FHA on manufactured homes, probably because it's the most lenient on credit guidelines and also credit scores. One thing, on the eligibility, most of your lenders are going to have a credit overlay. For instance, with the company that I work with Fairway, we currently can go down to a 580 credit score on just a standard single-family home with FHA. However, if it's manufactured, we're going to go with a little bit higher credit score. I believe it's 620 right now. So just kind of keep that in mind. If you do have someone purchasing this type of home, make sure that you let your loan officer know, because it may make a difference in the pricing. Because the investors do what's called risk-based pricing. And when I say risk-based pricing, it depends on their credit score. It depends on the amount of money that they're putting down on the loan. And it also depends on the type of home. You know, if it's a condo or a manufactured home, the pricing's probably going to be a little worse. Not a huge amount, maybe an eighth or a quarter higher on the rate. Some of the investors like VA and conventional don't require the engineer's report. However, most of your lenders, it's going to be a credit overlay. They're going to want the engineer's report on the foundation. So just another thing to kind of keep in mind. Even if the investor doesn't require the report, if the appraiser goes out there and they see a problem, they may turn around and ask for the structural engineer's report. Something with FHA and conventional, under those two programs, they will allow a non-occupant co-borrower also. And I think that's what makes it easier sometimes on these to get financing under these two programs. VA and, of course, USDA are 100% financing. On the USDA loan, the house has to be a new home with most lenders. They do have a pilot program right now that if the house was built after 2006, they will provide the 100% financing under the USDA. Now, all the investors, if the house was built prior to June 15th of 1976, you're not going to be able to finance it on what we call the secondary market, which is your conventional FHA, VA, USDA loans. I sometimes get the question, you know, what if it was built prior to 76? How are we going to get financing on it? Typically, those homes, because of the age, they're typically not worth a whole lot in today's market. You're probably looking at more of a land loan. If you run into a case like that, you're probably going to have to go to a local bank, and they may have to put 20% down. Some of the property specifics needs to be a double wide, minimum of 600 square feet in order for us to finance. FHA will allow single wide. Most lenders, here again, it's an overlay. Most lenders are not going to lend on a single wide. I think I've run into this twice in my 27 years of doing this, where I've had two in this area that were single wides. We were able to get the credit approved. However, there were literally no comps. You've got to have at least one single wide comp. So that's the problem that you're going to run into. So if you have a single wide, I would probably recommend that they get financing through a bank. I think it's going to be tough for them to get it on the secondary market. Needs to be a minimum of 12 feet wide. The property needs to be taxed as real estate. It has to be affixed to a permanent foundation. We get a lot of questions around what is a permanent foundation. Our piers, our block foundations. If they meet the permanent foundation requirements, yes. I have done some that have been on piers. So if it meets HUD's requirements, it can be on a crawl space, it could be on a basement. No different than a stick-built home. You might see some different variations. What they don't want to see is, the wheels obviously need to be taken off the unit in the hitch. Here again, they have to be built on or after June 15th of 1976, and they cannot have been moved from one site to another. And that's actually one of the requirements of the foundation report. It's part of the paperwork when these units are delivered. We know where the first location is. So if it doesn't match, we're not going to be able to finance it. Here again, if it's been moved, they're probably going to have to go to a local bank. They're probably not going to be able to get financing, the 30-year fixed on the secondary market through, Fannie or Freddie, FHA, VA, or USDA. Some other specifications for the property: the foundation report is required to make sure the unit complies. Something that you want to think about when you're writing an offer, you want to think about who's going to pay for that structural engineer's report. It's not cheap. It's probably $500 or $600. As a lender, we are not going to order the appraisal until we know it meets the structural engineer's requirement. I've had 2 in this area that have failed. One of them, in fact, the engineer called me and he said, "Tracey, I don't even know what to tell you. They didn't put tie backs. They didn't, or the tie down the straps or whatever." He said, "It's so low to the ground, they would literally have to get a crane and lift it up in order to fix it and put it on make it a permanent foundation to meet HUD's requirements." So, in this, and I don't remember who paid for the structural engineer's report, but in my opinion, I don't know if you'd want your buyer to pay for, this type of report on a seller's home and then find out they can't even purchase the home. So something to think about. It would be nice if the sellers would take care of this before they market to make sure that it passes. But it's just something that you want to think about, and you may want to write that in the contract. You may want to make it contingent upon passing that inspection before the appraisal is ordered. There's basically 3 things in the report when they do the foundation report. The first thing is it needs to state that the home has not been moved. The other thing is it needs to state what type of foundation that it's on, whether it's on a crawl or piers or basement. And then the third thing, it needs to specify that it meets HUD's foundation requirements when the inspector goes out and does the report. Community and private roads are acceptable. They must be owned and maintained, must have a private road maintenance agreement. We're running into this as being a problem, the road maintenance agreement. I look at it as an opportunity as a real estate agent. If you're going out to list someone's home and it's on a private road and there isn't a private road maintenance agreement, that you might want to take the opportunity to educate the seller as to why it's important to have it. As a lender, we don't want to be, we look at homes as we want them to be quote unquote sellable. So if we don't want to be in the real estate industry, and what I mean by that is if the home goes into foreclosure and we've got to market that home and it's on a private road that's not being maintained and there's no agreement, it's going to be tough to sell that home. So we kind of present it that way when we get, if we have a situation where there isn't a private road. It also protects everybody. We have a situation right now where we've got a potential seller that wants to list his home. He's 1 mile in on a private road, and he has literally always maintained the road. There's no road maintenance agreement. What we've suggested is try to get your neighbors to come over one night, maybe get your real estate agent, or they can go to an attorney, get someone to draw up an agreement, and it doesn't have to be anything elaborate. It can be something as simple as everybody in the community agrees, to chip in whatever the amount is to put gravel down or grade the road, once a year. It literally can be a 1-page document that gets recorded with the deed. But we suggested that just get everybody together, bring a notary, and just get a document signed that we can record with the deed. But I would look at it as an opportunity as an agent. You might be able to meet everybody on the street. You come across as the expert, you're educating. You might have an opportunity to list other homes down the road by fixing their, issue of not having this road maintenance agreement. Subject must also have ingress and egress for accessibility when there's no direct access from a county road, or you must go over someone else's property. I think this is pretty standard with any type of home. So if they're on any kind of shared driveways or anything like that, they just have to make sure that, we have the proper documentation recorded. specifications as far as the just some other things. There's going to be a HUD certification label or a HUD tag that's going to be located on each unit. So if it's a double wide, there's a tag on each unit. The appraiser is going to have to be able to locate those tags when they go out. If the tags have been removed, we have a way of getting that information. I'll talk about that a little bit later. Needs to be on a permanent steel frame or chassis. The wheels and axles and the hitch need to be removed. Property needs to be affixed to a permanent foundation. If an addition or manufactured home has been modified, must meet the state or local county requirements. If the state doesn't do inspections, then you must obtain an engineer's inspection regarding the work and safety, and the inspections must be on file. And I think we've talked about that earlier. So as far as the appraisal, the report must have photos of both the HUD, the data plates, and the certification label. The data plates or the tags, what we call them tags, is they're kind of metal. They're located on the outside of the unit. It helps if the seller knows where they are when you're listing the home. And if somebody can let the appraiser know before they go out there, because they do have to take pictures of them. And also inside the unit, it's probably in a cabinet, a utility closet, a bathroom or something. There's actually a label. It's about the size of a letter size piece of paper. It has all the specifications. It's got the tag numbers. It's got the serial codes. It's got where the unit came from. There's a lot of information on that label. And like I said, if the tags are missing, we can use the labels to locate the information on the tags to meet the investor's guidelines. Here again, the appraiser has to take pictures of the label and the tags. The other thing, the data plate label shows the wind zone, the snow load, the roof load of the home. So if somebody did hypothetically want to relocate a home, it's got to, this chart or the label inside the unit tells you where the homes can be located. So I always use the example, if you're moving a home from, say, Florida to Maine, it may not meet the guidelines because the roof may not be, might not be able to handle snow. Whereas in Florida, it probably is built different for wind requirements. So if you were moving from Maine to Florida, it may not meet the requirements. So that's something that when someone purchases a manufactured home, that they also need to be aware of, that they might not be able to relocate it in another state that they might want to move to.
Hey, Tracey? Just real quick, a question came in. Brandy asked, if the foundation doesn't pass, can it be fixed to still qualify?
Yes.
Okay. Then
yes.
The follow-up of that is, if you have a potential seller, can you take care of known finance issues such as removing tires, et cetera, prior to listing and still pass finance for the buyers?
I'm sorry, I didn't catch that.
The question is if the follow-up question to that was, if you have a potential seller, can you take care of the known finance issues such as removing tires, et cetera, all of those types of things, prior to listing and still pass the financing for the buyers? Yes. Okay.
And we would recommend anything, if you're going out to list the home and you see that the hitch is still on it, the wheels, and I think I've only run into this once. We ran into this once where they actually didn't remove everything, but it was on a permanent foundation. I think I've only seen that happen once. And I believe they did. I think they were okay with the wheels just because of the way they put it on the permanent foundation and you couldn't see it. And the foundation was fine, but the hitch had to be removed from what I remember. But if you see anything like that, yes, definitely, if they can take care of it before the inspector goes out, that way, hopefully you'll pass the foundation inspection.
Gotcha. Good. Okay, good. So
and sometimes, thanks. And sometimes if the seller has a previous foundation report, we may be able to use it, especially with FHA. I've had a couple situations where we've been able to use previous foundation reports on FHA loans. Hopefully, and the seller can actually go back to their lender. The lender probably has a copy of it. They probably microfished it. It's actually very easy to get. You'd be surprised. Most of these files are still on record. And as we talked before, the foundation inspection must address these 3 items. It has to, state the type of foundation that the property's on, needs to indicate that the property has not been relocated, and it needs to be compliant with HUD's permanent foundation code. Inspections. So this is like your well, septic, and termite reports. They have to follow investor guidelines. Ironically, and I tell realtors this all the time, Fannie Mae, Freddie Mac, and actually FHA, which is Ginnie Mae, they don't require well, septic, and termite reports, believe it or not, unless when the appraiser goes out, if they see a problem, if they see active, insects, or they see prior termite damage, they're probably going to ask for a pest inspection, or if they're aware of certain areas that there have been, well or septic issues, they may actually require it in the appraisal report. However, your real estate contracts have these items in it. So unless you waive them out of your contract, they're going to be required because we have to clear contract conditions. So just something to be aware of. FHA has the distance requirements, which I believe is 100 feet from the well to the septic field, and I think it's 50 feet from the property line. This FHA is probably where we have the biggest challenge, because the appraiser goes out to the property. We had this happen recently. They could not find the wellhead, and they finally, and it was a foreclosure, so it was kind of interesting. The real estate agent was really smart. She actually found the previous owner on Facebook, and they were able to get a location for the wellhead. So we were able to send the appraiser back out, and he was able to find it. But it helps if you're listing and any properties on well or septic, if there's some way that you can flag where the drain field is and where the wellhead is. When these appraisers go out there, especially on a manufactured home, they're not going to spend an hour looking for the plates on the home, looking for the label inside the house, looking for the wellhead. They're not going to spend time to do that. And I would say probably 50% of the time when we get the appraisal reports back in, especially on manufactured homes, the first thing that I do is I go to the report to make sure that they have all that information. And 99.9% of the time, they don't. So if they're missing one of those pieces, they're going to have to go back out. And the inspections are expensive. I mean, these appraisers are charging anywhere from $125 to $150 to drive back out to the property and locate that item. So just be aware of it. We had one recently. They couldn't locate the label, and the seller finally found it. It was in kind of an unusual location. I think it was actually in the ceiling or something. It was like a drop down, like attic door or something that was inside that. So the appraiser went back out. Well, she wasn't even able to reach it, and there was no ladder. Fortunately, the seller happened to come home when she was there, and they were able to get up, on a chair and snap a picture of it. But this was the third time that she had been out to the home,
Wow.
specifically because they couldn't locate these items. So it gets very expensive. It gets very time consuming. So I just say, as a listing agent, if you could please take care of these things before the appraiser goes out there, it'll go a lot smoother. Because the first thing we're going to do is call the listing agent and say, hey, we just got the appraisal back. We need help. We can't find these items.
Wow.
Something else to keep in mind, and I've run into this a few times over the years, that 100 feet that FHA requires, if it's between 75 and 100, an underwriter can make an exception and sign off on it. If it's below 75 feet, and I've only had this happen once, you can actually go to HUD, and we did, and we got an exception.
Wow.
I've seen where, and the only reason that I was aware of it is because I've heard other real estate agents say, oh, we couldn't sell that Go FHA on that home because it didn't meet the distance requirement. And we have an area here in Winchester, Shawnee Land, that a lot of the homes there don't meet the distances. What you have to do is actually go to the county or the sanitation authority and get more information. Apparently, there's a certain type of piping if it's, because the county also requires the 100 feet distance. So, but they will allow it if there's a certain type of piping used. So what we have to do is actually prove that that's the type of piping, and then we have to actually submit it to FHA. It really wasn't that difficult. It took maybe two or 3 weeks, I think, for FHA to approve it. But here again, if you know up front that we have a distance problem, with the well and the septic field, we can be working on that as a lender for you, right out of the gate.
Yeah.
And then
hey, Tracey, there's a couple of questions real quick.
Okay.
Let me tell you what they are. One is, have you run into any problems or have had any difficulty with homeowners insurance or home warranty insurance?
No.
No. Okay.
Homeowners insurance, West Virginia, and this could be any home, whether it's manufactured or not. I will tell you, West Virginia, it's not as difficult now, but we did run through a period there where we did have difficulty because of the replacement cost. And I actually called a couple insurance companies and said, what is going on in West Virginia? I don't understand. I was told that there's a lot of lawsuits in that area. And so a lot of the carriers didn't want to insure. They can't really redline. So what they do is they will literally give a ridiculous quote that nobody's going to accept.
Oh, wow. Right.
But we do run into the replacement cost. So if the home isn't worth real much, if it's not worth a lot, the replacement cost is where we potentially, but we've always been able to find insurance, knock on wood. But West Virginia is probably the only area that you might run into some difficulties, but that's literally with any home, that it's a challenge, but it's not nearly as bad as it used to be.
Yeah. Another one is, and what things you need to know where they are, the septic and those, what else? So in other words, it was asked if you could list those again.
Oh, just where the wellhead is and the septic field.
Gotcha. Okay. Does that help, Beth?
Yep. Yeah, that's where they need to make sure that the septic field is more than 100 feet from the wellhead.
Okay. Gotcha. Okay. Good.
And the property line. I believe it's 50 feet, but don't quote me on that. I think the wellhead has to be more than 50 feet from the property line. Here again, we've had some that are right up against, that are pretty close to the property line. I might be wrong on that. It may only be 10 feet. I have had some that were under that, not much, and we were able to get exceptions on it. But here again, it's, if we know up front, we can kind of run it by underwriting. Any of that we know up front helps.
Okay. And then the follow-up with that is label and electric box too?
The label that you find inside the unit, it could be inside an electrical box. It could be inside a kitchen cabinet. It could be in a bathroom. The weird one that we had was it was actually on a, I don't know, like a door that in the ceiling or whatever, like one of those attic doors or whatever. But it helps here again if hopefully the owner did not get rid of it. They're not supposed to take them off the units. If they are missing, let us know. There's actually a website out there that we can research and get the information. We might have to go back to DMV and get the original title so that we have the serial numbers. But we have a way of getting this information if the tags or the label are missing. Gotcha.
Okay, good. Thanks.
And then the last slide is on title commitment. And I'm going to be honest, this is the area that we have the most challenge. The title commitment must show that the manufactured unit title has been converted from a vehicle to real property prior to closing. You have to follow state requirements for surrendering the title. Here's what happens. The home comes from the manufacturer to the dealership. It's issued a certificate of origin, just like a vehicle. So it's taxed as personal property. The home goes from the dealership, gets put on land. 30 days after closing, the county sees the deed. They go out and assess the property. They know that it's real estate now. They start taxing it at real estate instead of personal property. So typically the personal property and tax bills are in the same tax department. So they know that it's not personal property anymore. So they quit taxing as personal property. They're now taxing you as real estate. The problem is that property, the title, if it's not turned into DMV, which a lot of people, for whatever reason, don't turn the titles into DMV, that seller still owns the home. And we learned the hard way as lenders. Back in around 2006 to 2009, I was working for one of the largest lenders in the U.S. I think we had over $6 million worth of buybacks, specifically in West Virginia on manufactured homes. And what we discovered was the titles, we never got proof that the titles were turned in. So technically, even though the house was on real estate, we went to closing, title was issued, and my understanding is title really only covers the land. The homeowner's insurance policy is what covers the home. And of course, they don't know. The homeowner's insurance companies don't ask for proof that the title was turned in. So what happened is 10, 15 years later, we have customers coming in wanting to refinance, and we're like, okay, we need proof that the title was turned in because we didn't do it 10 years ago. And we had to tell them, technically, you don't own this home. Not a pleasant conversation to have. Of course, everybody says, well, I don't understand. You did my loan 10 years ago. You have it now. You should be able to do it again. Not so easy. We can't. We already probably paid the penalty. Why would we do the loan again, make the same mistake, and get penalized again? We wouldn't. I actually had to have a guy go to DMV. Title wasn't turned in. Fortunately, he knew who the previous owner was. He had to actually go get the home retitled in the original owner's name, who had to surrender it to him, and then he turned it into DMV. And the only reason I'm bringing this up, this is where we probably had the biggest challenge, mostly in Virginia. Virginia's DMV records only go back 10 years. So if the current owner, if you're going to list their property, if they don't have proof that they turned that title in and they can't get it from DMV, they might have to go get title reissued and then turn it in to fix the problem. We just had one in West Virginia that we closed last month. Their title wasn't turned in. I was a little concerned because the owner had been in the home since I think it was 1999. Or no, it was the previous owner had been in the home, and this was, I think, the second owner. So now this would have been the third person purchasing. They were lucky. They went to DMV, and DMV had it on record. So apparently West Virginia DMV goes back forever, and they were able to prove that the title was surrendered. But the other thing with the title commitment is if it is a manufactured home, and this particular loan officer forgot to tell the attorney that it was a manufactured home. So they didn't find out till the title work came in, which was like a week before closing. When they found out, oh my goodness, it's a manufactured home, they knew they had to prove that this title had been surrendered, and they only had 5 days to do it. And like I said, they got lucky because the owner was able to go to DMV and get the proof. You're not always going to get that lucky. So at the beginning of the process, the seller really needs to make sure that they can prove that that title was turned into DMV. I think that's probably the biggest challenge that we have with these the manufactured homes. That's all I have. Does anybody else have any questions?
Yeah, if you guys have any other questions, go ahead and pop them in the chat box real quick.
And I just want to thank everybody for coming, for attending today.
You bet. Bob By the way, one thing I did want to follow up with folks is that, and I'd mentioned this to Tracey earlier, but what we're going to do is this presentation was recorded. I will be able to edit it so that we take out any of the stuff on the front end or the back end where it was just dead space. But what I will be able to do is send this to you as a link from Cindy Bishop's YouTube channel. Another question just came in. Any good recommendations for companies that finance when it doesn't qualify for FHA or conventional?
There used to be a company out there called Green Tree. I don't know if they're still around, but they used to finance a lot of mobile homes. BB&T used to. I don't know if they still do or not. But that's really it. You might want to check, I would almost check with somebody like Clayton Homes because they know, anybody purchasing a manufactured home that's putting it into a trailer park, they can't get this type of financing. So they probably have a list of lenders.
Okay. There's a couple of other ones too. Let's see. Follow up to that. You can get a personal loan as well as a lower value, correct?
Yeah, if it's manufactured in a park, it would be a personal loan.
Okay. And another question too then, Tracey, is when a client is buying land and building a new manufactured home, what should they be looking for in the land? Ooh, good question. These are all big.
Yeah, we go into a lot of detail in that on the CE class. They really need to check with zoning. They need to check the covenants. Unfortunately, a lot of areas won't allow manufactured homes, so you really need to check that first.
Okay.
And maybe even with the county, depending on where the property is. Gotcha.
And a follow-up with that is what costs are they looking at to put that new manufactured home in?
There's a lot to consider. You've got to consider the transportation costs from the dealership to the property. You've got to consider putting the foundation in, somebody to do the hookups to the utilities. And you want to think about warranties. You want, some of the questions you want to ask is, you also kind of want to do 2 inspections. You want to inspect the house before it leaves the dealership, and then you want to inspect it after they deliver it to make sure there hasn't been any damage. And also you want to make sure that the warranties do they cover the transportation? There's a lot of different warranties on these homes. Just because they're at a dealership, they're being transported. Now they're on the permanent site. So there might be different warranties throughout the process. On top of internal warranties on appliances and stuff like that. Gotcha.
Here's another question is, when and where is the CE class on this that you do for this?
I'm not sure when the next one is. I don't know off the top of my head, but the last slide I have up, cindybishopworldwide.com, is where all Cindy's classes are. And we do offer this class several times a year. And if you want, the other thing too, Cindy's open to, if you've got an office and you want us to do a class in your office, I think as long as we have at least 5 people attending, we can do that too.
Good. Okay, good. Does that answer? Okay, good. Awesome. Very good. This is good, you guys. I appreciate the feedback and the questions that you're putting in.
And if anybody else has any other questions, feel free to email or call me.
Yeah, and like I mentioned, you guys, I'm going to send the YouTube link to Tracey. Hopefully later on today, but by the latest tomorrow. But she'll likely be following up with each of you guys by email, just so that she can get the link to you and answer any other, and establish a connection with you as well. So if you have any other questions, and you can handle that. So okay. Well, this is good. This was helpful. Thank you very much, Tracey. This is good information. So
thanks, Dave.
Yeah, you bet. Thank you guys for attending. We really appreciate you. Oh, wait. Oh, good. Awesome. Very good. Says you've been friendly on Facebook. So very good. Thank you, Beth. Awesome. All right, you guys. Well, thank you again for attending, and we'll see you at the next webinar.
All right, great. Thank you all.